Hello, and thank you for your interest in the Public Employees Retirement Association of New Mexico's Legislative Finance Committee Pension Solvency and Investment Performance presentation. Most importantly, thank you for being a member, retiree, and beneficiary. My name is Christina Perea, a Public Relations Coordinator for PARA, and I am joined today by Dominic Garcia, who is our Chief Investment Officer. PARA is committed to cultivating relationships throughout the state by providing outreach services and disseminating vital information on a timely basis. On an annual basis, PARA reviews its channels of communication and seeks new and progressive platforms to ensure that its messages are conveyed to all audiences. This process is crucial as our audience will continue to utilize what advancements of technology are available. During the next few months, PARA will be providing a video and blog series pertaining to solvency issues. Today, Dominic will provide us with an overview of what the PARA Board of Trustees has been working on for the past year and a half to help secure PARA's solvency. Dominic will also guide us through some potential solution packages that the board hopes to submit as possible solutions for the upcoming 2019 New Mexico legislative session. PARA also invites you to attend a series of upcoming in-person presentations which will be provided in 9 cities throughout the state during the months of October and November. We encourage you to follow our PARA website and social media sites to obtain these upcoming presentation dates and location information. So first off, thank you so much, Dominic, for being willing to share these solvency updates. I'm a member myself, and so I greatly appreciate you, our Executive Director, Wayne Probst, along with our Board of Trustees, for coordinating these online and in-person educational opportunities. It means a lot, especially if we're not too familiar with what's going on, and being a proactive member, it's wonderful that you guys are offering this, so thank you.
Well, thank you, Christina. It's a pleasure to be here and to discuss these issues and to try to get this information out to our members. And I must stress, I too am a member, and I have many family members that are members, including my godmother, so believe me, my godmother gives me a mouthful of all these issues, and I couldn't have a bigger critic in my corner to talk, asking all these questions than her. So I appreciate having this conversation with you.
Great. Yeah, we don't want to upset your godmother.
Yes.
That wouldn't be good.
Yes.
So first off, with this first slide, Dominic, I see that there's a picture of an iceberg in front of us, and it kind of scares me, but I'm hoping you're going to talk a little bit more about that. But I'm assuming it's a metaphor for something, especially that maybe pertains to our PARA Trust Fund, etc. Can you talk just a little bit more about what this means?
Sure. So this presentation was actually shared at the request of the Legislative Finance Committee in August, and we used the metaphor of an iceberg to talk about our solvency. And I think everybody's aware of what that metaphor is, and I just want to kind of give you the two views of it. And it's obviously above water. You can see an iceberg, and you can see what's ahead of you. You can see the mass ahead of you. And today's view, when you look at PARA above water, we have a fund value of about $15.6 billion. We have a solid funding ratio, which is a little above the average nationally at 73%. We project that over the next 25 years to about 2043, our funding status would be about 77%. And that 77%, I must emphasize, assumes that we hit all of our assumptions perfectly. We hit our 7.25% return perfectly year over year, which is not going to happen. But if we hit those assumptions well, we'll get to 77.1%, which kind of is a flat line of our funding status over the next 25 years or so. So it's not a bad view. But I think what's important, and what we talked to the legislature and what we've been telling our board and what our board has been asking us questions about is, well, what's underneath the water? What's that mass underneath? And is that mass underneath truly a problem? And I think that's the point of this solvency conversation and the conversation that we've had with the legislature, with the board, and some of the evidence and some of the facts that we're going to present today is there is something under the water, and I think we all need to be aware of it.
And so really at the end of the day, right, Dominic, I mean, overall this presentation, you're going to provide us with that information because we don't want this iceberg essentially to turn upside down, correct? We need to do something now, not only for us, but also for future members, retirees, and beneficiaries, correct?
That's true, and I think all of us members would would all recognize that PARA has been a wonderful, is a wonderful institution that we pay out over $1.1 billion in benefits year after year, last year actually. So we want to make sure that this benefit not only serves people for today, but it serves people for the future. And I think it's a relevant and very beneficial system for the state of New Mexico, and we want to make sure we protect it and keep it sustainable long after I'm gone. Let's put it that way.
Great. So we'll move on and see what Dominic has to say and provide an overview for us.
So Christina, if we talk about here on slide 3, this is really where we are today. So the blue line here kind of shows you our funded projection over the next 25 to 30 years. And this is based off of our current assumptions that we've made. And these assumptions assume a bunch of different things, particularly mortality assumptions, which have increased. Our members are living longer than what we've experienced in the past. And our investment assumption as well, which is a 7.25%. That was recently reduced from a blended 7.5%. And the 7.25% basically means that over the next 10, 20, 30 years, this is about roughly what we would expect to return on our investments. And as you can see, by making that investment return assumption and updating our mortality tables, our future projection of our funding status has gone down from previous assumptions. So previously, that was about 87% out to 2043. Now it's been reduced to 77% to have some more to update those more realistic projections. But what's important on this graph is just to know that our funding status is solid, but it assumes that we hit these assumptions day in and day out. So there's very little room for error for us to make any mistakes. And in any room for error in investments or et cetera, and you will see a change of these assumptions as it kind of flatlines over the next 20 or 30 years.
So is it safe to say, Dominic, based off of the iceberg metaphor, could this graph kind of just in the same way display that, everything looks good, but if we don't do anything now, then basically that iceberg flips?
Yes, I think that's a fair way to think about it. Is again, we're seeing the top part of the iceberg here. We're seeing a flatlining of our funding status, but as I mentioned, it's a thin line, and so that if we see any recession here over the next 5 or even 10 years, and we see a downturn in the markets, this picture can change dramatically. And if we have any other assumptions to our liabilities, this can change as well. But I think the biggest event is any market disruptions that we can see. We can see a dramatic change to this picture.
Okay. And so I'm going to ask the question, Dominic, and it's probably something that all of our members or either our retirees and beneficiaries are going to ask. How did we get to this, essentially?
Well, Christina, first, it didn't happen overnight. And I think this story of how we've gotten here has really been over the last 20 years. And the story really is talking about that mass under the water of that iceberg. And so I want to start back 20 years ago and take everybody back on a little history lesson. Going back to the mid-1990s, I think everybody kind of can remember back then, that first investments were plentiful. Returns were plentiful. Very simple portfolio of a 60-40 portfolio produced double-digit returns. Investors were producing in returns well beyond their actuarial hurdles. And at that time, PARA actually increased benefits quite a bit, moving our multiplier from 2.5 to 3 times. And largely, much of that was unpaid for, meaning that investments were expected to make up for the bulk of that cost. So at that time, PARA was roughly, over 90% to moving to 100% funded, and we increased those benefits at that time. And just as a side note, we weren't alone. Many pension systems around the country did the same thing. But once we did that, let's fast forward to what actually happened in the marketplace. So what actually happened is after 1997, when we increased those benefits, we actually very shortly thereafter had the dot-com bubble and its bust, which had a negative impact on our returns. And 7, 8 years later, we had the Great Recession, which had a very negative impact on our investment returns. So if you look over the past 20 years since those benefit enhancements, we returned roughly 6.4, 6.5% return, which was below our assumptions. So when you put that in conjunction with that benefit enhancement, plus we paid COLAs well above CPI during that whole period of time, we actually at 2012 ended up with a 65% funding ratio, and we were looking over the next 10, 20, 30 years at basically insolvency at that point. And so that was the big impetus for the 2013 pension reform. And the 2013 pension reform actually was quite successful. Well, what were the two big things it did? One, it reduced the fixed COLA that we pay retirees from 3% to 2% and deferred it for 7 years for new retirees. And then it created a new Tier 2 benefit structure, which changed how the defined benefit actually was paid for any new employee going forward in 2013. So those things in conjunction, they actually set us on a better path, on a sustainable path, on a more sustainable path. It took us from the doldrums of solvency to where we are today, which is roughly 73% funded to moving out to maybe about 77% funded over the next 25 years. So it got us onto the right track, but it's still not enough to get us at full solvency or full sustainability over the next 25 to 30 years, and to ensure we're dealing with that mass under the iceberg.
Okay, so thank you for that little history lesson, Dominic. I appreciate it. I know that you, along with Paris staff, as well as the Board of Trustees, have been studying this for the past year, even for the past year and a half. So I know I've heard some people suggest that we beef up on our investing to get us out of this funk. What are your thoughts on that?
Yes, so we, the board, our experts, and our staff, we've gone through a lot of different scenarios and homework about how, one, understanding what the problem is, but two, what are potential solutions. And I know out there lots of people talk about, well, let's have investments make it up. Just kind of how when I gave my little history lesson, that's kind of what was the thesis for the 1990s. Oh, we can increase benefits because investments will make up the difference. Well, let's talk about how whether or not investments can make up the difference. It can make up that $5.5 billion of unfunded liability. As I look forward, I think there's probably three big challenges that we're facing as an investment officer or any institutional investor. First, as you look forward over the next 10 years, the consensus among investment experts is that we'll be seeing a lower return environment, certainly lower than what we've seen over the last 30 years. And that really stems from two things. Number one, if you look at where stock valuations are today, they're near generational highs in valuation. And so historically, when stocks have reached these valuation levels, and you look 10 years forward, returns on stocks have been pretty modest to disappointing. And so that's kind of where we see ourselves today. Second is, if you look historically, the return on cash has been anywhere from 3, 4, even 5%. Today, the return on cash is quite modest. So those two things, taken to conjunction, actually put a pretty good crimp on the expected return environment over the next 10 years. And just as a final simple example on this point, is if you were invested in I would call a simple portfolio, a 60-40 portfolio of 60% index stocks and 40% index bonds, over the last 30 years, that generated something like 7.5% return. But now take into account that valuation and that lower yielding cash that, as I talked about, when you look over the next 10 years, that simple index portfolio is only about a 5.5% return forecasted. That's 2% difference. That's a big difference in investing. And so as an investment officer, as a staff, you've got to be a little bit, we got to do things a little bit differently. We got to be a little bit more creative and innovative to try to make up that gap. It's a significant gap. So that's number one challenge is it's just going to be hard to get to our 7.25% return. Second is I think we can agree that we're in a late kind of economic cycle. So the chances of a recession or the chances of a market downturn, let's call it over the next 5 years, are probably fairly good. So what that means is that there's a potential for us to experience some poorer returns over the short run and get better returns over the longer run. That we, in that scenario, we still might get our 7.25% return. But if we get poor returns up front, that actually is a problem for us because month to month we're paying out benefits. And so if you get returns in the short run that are poor, you're not able to compound that return as much. And so over a 10-year period, we might make 7.25% return. But if you get the poor returns at the beginning, you're not able to compound fully and you actually have less wealth. So it's a very technical issue, but it's a significant issue for us investment staff for us to really think about. So with those two significant challenges, let's add on the challenge of trying to make up our shortfall, our $5.5 billion shortfall. So in this slide, I've actually calculated that. So to make up our $5.5 billion unfunded liability, we'd need to generate something like an 11% return over the next 10 years. At our current portfolio, that's something like an 11% probability that it's happening. And now, as I mentioned, over the next 10 years, it's going to be a challenge just for us to get to 7.25% return. We actually have some initiatives that we've been working with the board, and the board has approved the first leg to enhance our portfolio so we can increase that expected return. So even if we do that over the next 3 years, the probability of us even getting to that catch-up return of 11% is about 18% probability. Very, very low probability. So that's a long-winded way of explaining to you, Christina, of what I would say is I wouldn't depend on investments over the next 10 years to make up for our 5.5% shortfall. As a matter of fact, I think we need to think about it in a more holistic fashion. Having investments just make up for the past deals is much too much to expect and way too high of a bar. We've got to look at things more holistically to continue to sustain our plan going forward.
So Dominic, I know I've heard you talk a little bit about our liabilities, and for someone that may not know what that terminology is, for example, myself, that's something I've never really heard of or understood before I started working for Para. So can you talk a little bit more about liabilities?
Sure. Liabilities, pretty plain and simply, is that promised benefit that we've made to our active members and our retiree members. And that promised benefit, you could actually break it into two parts, is that day you retire, that our members retire, that's their defined benefit. That's based off of their years of service plus their final annual salary, etc. That's number one promised guaranteed benefit. Second is the awarded extra benefit that we provide after you retired, which is the COLA. And we've historically paid that at 3%, and then more recently, after pension reform, that's been reduced to 2%. But all that collectively, those two pieces of our members' benefits, that defined benefit and that extra awarded COLA after they retire, combined are our liabilities. And so when you look at those liabilities today, and I think this is something that most people don't quite understand, is that of our $20.2 billion of liabilities or promises we've made, 13.5 billion of that, or almost 70%, is of our current retirees. In fact, our current Tier 1 retirees. Only 30%, or 6 billion, is to current working actives. That's actually a pretty big, astounding distribution of our liabilities. 70% of our liabilities are for current retirees. 30% for actives. That really creates a math problem for us. And to delve a little bit further into our retiree population, this is actually quite interesting. So let's just take a look at that $13 billion liability that we have with our retiree population. What's interesting is actually most of that is for retirees that are under 65. As a matter of fact, in that group of folks, which make up about $8 billion of our liability, the average age of a retiree is 55. So, which is a wonderful thing for our membership, is we actually have a quite young retiree pool, which is a great benefit for our members and for the state of New Mexico. But it also creates a big liability for us, particularly when we're seeing mortality increase over the years.
So Dominic, in the research that you along with other staff and board of trustees have done over the past year and a half, you also went through modeling scenarios, correct? Can you talk a little bit about that?
Yeah, Christina, we did. So we've looked at, from a different point of view, is okay, if we expect to return about a 7.25% investment earnings over the next 25, 30 years, and we have this liability stream, which I just talked about, is majority coming from retirees, and we have this expected cash flow, how do we put those two things together to model out our funding status, our cash flow needs for the pension system? So we engaged our consultants to help analyze this, and we've done many different scenarios on this, but really what it does is it takes a whole bunch of different modeling scenarios, and it's called Monte Carlo simulation, just to give you some jargon. So we've modeled 500 different scenarios of investment returns, random series of events, to see what would be the outcomes based off of our liability stream and our cash flow of our funding status in all those different outcomes. And we've looked at different outputs. So the median is the base case scenario, or the 50% chance that occurs. And then we have a good case and then a bad case scenario. And what we've done is we've done a bunch of different modeling on that based off of our expecting return. But the modeling is, well, what happens if we change something to the benefit structure? What does that do to our funding status? And this is what we shared with the legislature and what we've shared with the board over the last year and a half or two. And we've looked at dozens and dozens of scenarios. But what we're going to talk about here is just a handful that we selected to show to the legislature. And we'll share it with you, members, so you can see the changes of different proposed benefit structures.
So when you were looking at these modeling scenarios, Dominic, was there anything that stood out to you when conducting all of the 500 or so different scenarios?
Yes. I think the first thing that really stood out for us is, and again, it's going back to that metaphor of the iceberg, is there's a thin line. We have a very, very little room for error, particularly on the investment side. And I think this slide here actually shows this. So this is actually our current assumptions, and maybe this will give members a little feel for what we're going to talk about. But where we're at today, and in this slide, we're showing about a 72% funded ratio. But what we're showing are the different scenarios. So the green is that good scenario, when we make returns back like we did in the 90s. Very, very, very good, strong returns. The purple is where we just make our 7.25% return. And then the blue is where we just underperform that 7.25% return. And then the yellow is a kind of a worst case scenario. So what's important for me, and an important takeaway, is even in the scenario where we just meet our 7.25% return, our funding status flatlines pretty much into all time periods. But if we have any hiccup, a 6% return, we look more like that blue line, which is not a good outcome. So there's not a lot of room for error is the point. So for members that are listening in, if you forget anything I say, I want you to pause on this slide and try to study it to the extent you can, and I'll do my best to explain it. But I think this might be the most important slide, and doing all of the work that we've done over the last year and a half, at least for me, this was probably the most revealing slide and piece of information that we discovered. And what this shows is our expected cash flow, or the payout of our benefits over the next 20, 30 years till 2047. And I call this a little bit of a pig in a python because I think you can see that a little bit. And this really shows those past ills or that history lesson I was talking about, where back in the 1990s we had the benefit improvement, and then we overpaid COLAs above CPI over the subsequent 20 years. This really shows that overpayment and those improved benefits, all that cost coming home to roost. So I'm going to start with this purple line. And this purple line, again, this is our base case expectation, meaning that we get 7.25% returns over this entire period. What this shows is based on the current liability that we have, and again, 70% of that roughly is coming from our current retirees. We get to a fairly unsustainable cash outflow level. Today, we're somewhere around 3.75% that we're paying out in cash relative to our investment returns. Somewhere around 2040, in the late 2030s to 2040, that peaks out to 5.5% of our cash flow, of our investment returns. That's an uncomfortable position for us to be in. Secondly, if we don't meet, or if we just are if we are underneath our 7.25% return, we can see that blue line here. And that blue line, because of that pig in the python of all that liability that we're seeing forward over the next 10 to 15 years, that can definitely get us into an unsustainable and insolvent cash flow perspective. So this is a quite important picture and shows the strain just current liabilities, current assumptions, our current baseline has on the pension system. It's something we've got to work through over the next 15 to 20 years, getting that liability through the system so that sustainably, so that once we get to about 2040, we can hit a sustainable period. By the way, that 2040 roughly corresponds to when we see the Tier 2 changes really kick into the system. But it's really, until then, we've got to work through that past liability, or that pig in the python, as we call it.
So really, Dominic, with this, and I understandably so that this is probably the most important slide, and really stress that it's a pretty difficult graph, and I know para staff, para board of trustees are facing a lot of pressure to come up with the solution, I expect. So can you talk a little bit more about going forward? I know you guys came up with a decision tree in the last para board retreat. Can you talk a little bit more about that?
So yes, we did look at many different scenarios, dozens of different scenarios, and I think what we looked at is, this is, on that previous slide was our problem. We have that liability strain, that cash flow strain. And so it's okay, well, what are the different scenarios that we can do and employ to help fix that situation? And, and I talked about one of those is that let's invest our way out, and I talked about how that's a very low chance of that actually producing results. And so it's really, what are the different changes we can make to the benefit structure that are palatable and reasonable, that we can actually create a better picture than that pig in the python. And we looked at dozens, and actually at the board retreat this past summer, we spent a lot of time looking at different scenarios, and this is just a quick synopsis of those, and a quick synopsis, and the following is a quick synopsis of the ones we shared with the legislature. But we looked at different packages, so to speak, and I'm going to, at a very high level, talk about what those packages are. But when we actually look at our liability stream and the impact that they got to make, it really comes down to really two levers that the board or anybody can pull to effectuate good changes that actually impact positively our funding status. As everyone's well aware, that defined benefit, that day you retire, is deemed a property right. And so changing that is going to have its legal challenges. So what that really creates is that there's really only two things that we can change, and that is active member contribution rates and any refinements to a COLA. So those are the genesis or the basis of a lot of the different scenarios that the board has looked at thus far. So in those scenarios, what we've looked at in kind of all of our base packages, we looked at, okay, what if we have an increase in contributions by 2% by active employees? What if we do a COLA freeze for 3 years? And then we had different scenarios of, after that freeze, we have the COLA turn into something different than what we've done in the past. And part of that is that we would defer it or change the age of eligibility from 67 for general employees and 60 years for public safety. But those are the scenarios we've looked at, and we're going to highlight 3 of them now, and that's what we're going to talk through for the rest of the presentation. So one scenario we looked at is, okay, can we make a few changes, as I mentioned? Maybe we can adjust some changes for the benefit multiplier. We can increase our contributions from actives. We would freeze the COLA. We would, for 3 years, we would change the eligibility for the COLA from 67 to 60. And then after that freeze, the COLA would move from a fixed 2% to be based off of whatever the CPI is, with a minimum of 0 and a maximum of 2.5%. So that was one scenario we looked at, and we'll see how that impacts our funding ratio and our cash flow. So we can see that type of package, and again, based off of those funding status of the good scenario in the green, of the baseline scenario that we get 7.25% in the purple, and then a bad scenario, and then the worst scenario, we can see that improves our funding status. And as a matter of fact, it improves it a little bit immediately. But more importantly, over kind of a targeted period over the next 25 years, is over that 25-year period, we're trying to see if we can get to 100% funded, would be a goal. This scenario actually does a pretty good job of doing that. So in our base case scenario, we think over 25 years, we get to about 92% funded. And we have about a 47% chance of being fully funded in that 25-year period. So that it's an improvement from today, most definitely. But let's look under the water, under that. Let's look at that bottom part of the iceberg. Let's look at our cash flow. Let's see what it does there. So looking underneath the iceberg, if you compare this to that baseline, or where we are today, if you compare that pig and the python, we can see that pig got a little smaller, but it's still significantly there. So overall, this package does an okay job on the funding status, but the cash flow impact is modest, I would call.
And would you even say too, Dominic, that the peach area at the bottom, is that still looking like we would still be like in a dangerous area?
Yes, and I think that's a good point, Christine. I think that middle part, the light pinkish, maybe not so the red part, I think it's an uncomfortable position for us to be in. You know, to ensure that we're in a sustainable system, I think we'd like to see that purple line, our baseline, to be mostly in the green. And I think we'd like to see that blue line move up some more. So this scenario that we talked about, moving the COLA on the eligibility and turning it into a CPI based with a 3-year freeze. It improves our cash flow, but modestly so. So the next example that we highlighted for our legislature was the same as before, but one change. Instead of doing the CPI COLA, we said, hey, at the end of the year, what if we give our members, our retirees, a 13th check of 5% of their benefit amount? So, for instance, if your benefit amount is $20,000, you'd get a 5% pay of that, uncompounded. So, let's see the results of this scenario.
And with this scenario, before we move on, Dominic, in particular, on the road, when I'm providing seminars, I hear members saying sometimes that it's kind of a bummer to have to wait for the 7 years to receive their first COLA. So what you're saying here is with this package, it would mean that members would have to wait. They wouldn't have to wait so long for their COLA.
Yes. So in these two packages, in lieu of that 7-year deferral, which is existing today, we changed the eligibility age, right? So in this instance, you have to be, if you're a general employee, you got to be 67. And if you're a public safety employee, you got to be 60. And you don't have to wait that 7-year period.
And even with this change, the funding ratio would definitely improve.
It would, and you can see that on the next slide. So you can see, I'm going to focus just on this purple line, which is our base case that we generate 7.25% returns. You can see we actually, we project in 25 years that we have a significant probability of being overfunded. So we can go from a 73% funding today to something around 117 would be our base case. So clearly that's a much improved funding status scenario. But again, let's look under the iceberg and let's look at that under the water scenario on the iceberg and see how our cash flow looks, how that pig in the python is being affected. So as you can see, this is actually an improvement as well, except for the cash flow needs here in the short run, in that purple line, are actually a little similar, if not a little increased. But over the long run, because we're not compounding that COLA over time, the cash flow needs or that strain reduce. This is a significant change, and this is a significant improvement, I would say. But still, a little more strain here in the short run on cash flow, but overall, a much improved picture.
Yeah, you can see that it's a lot more, it looks like it would be a lot more healthier, sustainable. So now I'm a little bit more curious to see about another package option.
So this last scenario is something we shared with the legislature that we call a risk share. And the risk share is quite interesting. It's a risk share of the COLA. And what it simply means is that we pay a COLA when we actually have the money in the bank or that the investment earnings support it. So as an example, I talked a little bit earlier in my remarks about our history lesson over the last 20 years, about how we overpaid a COLA versus our CPI, but we also overpaid our COLA relative to what we actually earned in investments. So over that 20-year period, we paid mostly a 3% fixed COLA, but we only earned enough money over that period to really pay a 1% COLA. So that extra 2% that we paid out, you can think of it as we paid it on our credit card. And we're seeing that liability come through today. So a risk share, in a very simple way, switches from paying our COLA on a credit card in a fixed way to our debit card and in a variable way. And so we pay it out only when we have the money. So when you actually analyze our return, our liabilities, it turns out to pay that defined benefit that day a member retires and that's earned that service credit and final average salary, the cost to pay that is roughly about 5.5% on investment returns. So the risk share COLA that we're showing here, we would pay it out whenever we have returns above 5.5% return. So it gives that extra added bonus, but it's it's paying on our debit card and when we have money in the bank. So that's the feature we're showing here. But importantly, in this scenario, I want to highlight a couple of other things. So we don't have any age eligibility. So any age that members retire, they're eligible one full calendar year after retirement for this feature. There's no deferral. So you're getting it after 1 year of retirement and at any age, and you're sharing in whether or not we have the returns. And so we've also said that there's a floor of 0%, meaning that if we return less than 5.5% over a period of time, there's no COLA, but we can pay out a maximum of 2.5%, which is greater than what we're paying now. And once we're 100% funded, we can pay out a COLA up to 5%. So the member actually has a lot of upside in this scenario. And again, it's paying out only when we have the dollars and when we actually made the money, paying it on our debit card versus our credit card. So let's look at the results in this scenario. So one other feature about this benefit structure is that we've seen a lot of fully funded pension systems around the world employ this mechanism. So let's look north to some of our friends. Up in Canada, most of the Canadian public pension systems use this method, and on average, they're about 99% funded. The other example here in the United States that does this is the Wisconsin pension system, and they've been 99% funded over the last 30 plus years. Now, as a matter of fact, in the Wisconsin example, over the last 35 years, they've paid an average COLA, or what they call dividend in this scenario, about 3.5%, which is well above CPI and well above what we've paid here at PARA. So this system, this benefit structure works really well with other pensions that we've seen employ this for a number of years. So let's see if we applied this to PARA, what actually happens. So let's focus on that purple baseline. As you can see, our funding status increases significantly from where we are today in 2043. And within about 27 years or so, we would see a fully funded pension system. But importantly, and I'm going to focus just on this purple line, remember in this scenario, it's a variable COLA. We're paying it based off of expected returns over time. Or actually, I'm sorry, the returns that we actually gain over that period of time. So on average, members are getting about a 1.3% COLA. In a good scenario, members are getting about a 2.4% COLA. In a bad scenario, you're still getting a COLA. You're getting a 0.7% annual COLA, and these are all compounded. So in good scenarios, you're getting well above what you're getting today. In our baseline scenario, you're getting a pretty reasonable, meaningful COLA of 1.3%. And even in a bad scenario, we're paying out COLAs. And guess what? In that blue line, in that bad scenario, we're still 60+% funded.
So even at our worst, we're still going to be doing good with this package, correct?
In a bad scenario, we're still in a sustainable path while paying out COLAs.
So again, Dominic, if we were to treat everything, like it was a credit union, for example. So if we have the money, we'll distribute rather than paying out COLAs left and right with the credit card. So what would it look like with our cash flow?
So Christina, great question. Our cash flow improves. And again, it's because when we earn the money, we'll pay it out. We're more than happy to. And again, we're doing our best to earn a return above that 5.5% return, as I mentioned. And as we do, we have excess cash, and so we can pay out an excess benefit. And so on this slide, on slide 21, you can see how our cash flow improves significantly. That purple line is almost always in that green area. In our bad scenario, the blue line is more manageable. So that pig in the python, quite frankly, goes away to a large extent. So paying on our debit card when we have the money is a big boon to that cash flow liability, what we would project over the next 15 to 20 years. And then particularly, it serves as a wonderful bridge when our Tier 2 retirees kind of really come online in about 2040 and really kick in. And we get to a very sustainable path.
So I know even other feedback that you've gotten, Dominic, some say that let's look at our vacancy rates to see if that's a potential solution. What are your thoughts on that?
Yeah. So we've gotten a lot of suggestions, and over the past year and a half or 2 years, as we've been studying this very deeply and doing dozens and dozens of scenarios, this is one that we've examined. And this is actually one that our legislature asked us specifically to examine. And the bottom line is if we reduce our vacancy levels in the state general division plan, it has a very modest impact to our funded ratio. And you can see that in the 2043 column, there's a slight improvement. But again, it's not a silver bullet. It is something that has a modest, if not incremental, change or improvement, but it's not a wholesale silver bullet change to our funding status.
So I know another suggestion, Dominic, has been the idea of possibly receiving money from the state to help, but that wouldn't even solve our problems, right?
That's correct. So we've gotten all kinds, right? So what if we get a one-time payment from the legislature? What if we cap pensions at $100,000? What if we change the 90% of what the 90% final average salary? What happens when we do those things? Well, let's take one at a time. So let's assume that the state is generous and wants to give us $100 million to help solve our problem. More than welcome, take any money that the state's willing to give us. But $100 million, it's a very incremental improvement. Again, we're dealing with a $5.5 billion unfunded liability. $100 million from the general fund or from any other source is a very incremental change to our funding status and cash flow. As a matter of fact, we pay out $100 million a month. So if we got $100 million from the legislature extra, that would just literally go out the next month to pay out benefits. So it's welcomed but incremental. And let's think about these other issues of what if we cap pensions? What if we have above 100,000? I know this has been a perception amongst many, but we've actually done some work on this. So we out of the 38 to 40,000 retirees currently, there's only 49 retirees that are receiving pensions above 100,000. So capping pensions at 100,000 doesn't do anything. It doesn't even turn into a rounding error. And so others have talked about this idea of, well, there's an issue with people having the ability to get 90% of their final average salary if they continue to work beyond their required years. They can max out their benefit. There's been talk about changes with that, but quite frankly, that provision actually is a slight benefit to the system. So in that scenario, members are incentivized to actually work longer beyond what we actually expect. And so their money is in the fund longer, and we're able to compound that money longer. And actually the amount of time that we have to pay their lifetime benefit, it reduces a bit. So on net, that's probably an incremental benefit to us. So changing any of that, that's not going to do anything to the solvency of the fund. So we've looked at these other things, and as I mentioned previously, they're small and incremental and have very little impact to the solvency. It's really, at the end of the day, what's the contributions and refinements for the COLA that do anything to change our funding status.
So I know that you've provided information, Dominic, on the most valid solutions that you've come across. But what is one thing you want our members, our retirees, as well as our beneficiaries to take home from all of this?
Yeah, so the first thing is the board continues to examine these issues. There is no solution yet. We continue to examine different possibilities of benefit structures, etc., and the board will be working through that over the coming months. But there is one big takeaway from this presentation and the work that we've done over time is this cash flow. It's this pig in the python, and on this slide 24, it's this picture on the left. At doing nothing right now, we have a pig in the python. We have a cash flow problem, and it's going to be a significant problem and strain on the system for the next 15 to 20 years. Doing nothing is not an option. But the right-hand picture, and actually this example is that example of that risk share that we talked about. What we need to do is we need to tighten up those outcomes, particularly those bad outcomes. We need to make sure that we have a structure and a system where we can sustain bad outcomes, and bad outcomes particularly on our cash flows. And what's good to know for members is that we know where the problem lies and what it is. And what's important to take away is there are solutions. And I think there are palatable solutions and reasonable solutions that the board continues to work through. But it's really this. It's making sure that in bad scenarios, the system continues to be sustainable and continues to be sustainable from a cash flow perspective.
And I've heard you even say this before too, Dominic, is that we want it to be something that we can live with.
It's something that we can live with in a bad scenario that we believe can still continue on as a forever sustainable system. And because bad times can come, and we need to be able to not have to go back to the legislature, go back to make more changes. It's got to be, the system's got to stand on itself, and I think there are solutions for that. And so what we're really trying to avoid is this picture, and it's getting back to that analogy of the iceberg, is we do have a big mass under the water, and we talked about it. It's that pig in the python and that cash flow. We just don't want that to flip us over and sink our iceberg on the top. That's what we're trying to avoid. And again, there are solutions. We think we can avoid the problem, but we don't want that to engulf us and sink us, that giant mass under the water.
Yeah, I'd say we definitely don't want that iceberg to flip. Do you have any final thoughts that you would like to share with everyone, Dominic?
Yeah, I think the final thoughts are, I think members should feel good about, we're in a solid position today, but what the story I've told is it's a thin line, and we need to be aware of that mass under the water. And we are. The board and the staff are aware, and we are aware of that issue. And I think for members it's important to recognize also that the board is on top of this issue for the last year and a half, 2 years with staff. We've researched a ton of this with our experts and our consultants. We've looked at so many different scenarios, and we continue to do so. But it's over the next couple of months that the board will spend a little extra time and narrow down those solutions, narrow down to a recommendation that we'll provide to our legislature for their consideration. But I think the final thought is, yeah, there's a problem, and the first thing is we've identified the problem, so now we know how to fix it. And there are solutions. They're reasonable solutions, and now it's just trying to get to a refined solution over the next couple of months.
Great. So I know it's my understanding from everything that you've gone over today, Dominic, that you, along with Paris staff, the board, you're wanting to find something that benefits everyone, and not just active members, retirees, and beneficiaries. And it's something that's going to have to continue for years to come. So thank you so much again for providing today's overview. Um, we really, really appreciate it.
Thank you. It's my pleasure.
If you're interested in learning more about any upcoming solvency presentations and just other informational opportunities, we encourage you to follow our para website. We'll be having a solvency page that has all of every solvency related information. And we're also going to distribute everything over social media platforms. And so Dominic and I are going to continue this conversation with the blog series on, just some important topics that we think everybody should know about. So please keep an eye out for those. And again, thank you so much for being a para member, retiree, and beneficiary. We really appreciate you. Thank you.